Hello, and welcome to another episode of ETF 360. I'm Kirsten Chang, Senior Industry Analyst at Verify, and I'm excited to be joined by John Lawlor, Managing Director and Portfolio Manager of the New York Life Investments MacKay Municipal Bond Funds. John, thanks so much for joining us. Great to have you here.
Great. Thank you so much for having me.
Of course. First off, let's talk about the muni market right now because it's been on a bit of a roller coaster ride. They started the year with a big sell-off, but went down to dirt cheap levels. Almost the cheapest levels we've seen in the last 15 years. But how are they looking right now?
Yeah, that's a really good observation. I mean, munis look really cheap right now. As you said, they've underperformed pretty much every other fixed income asset class year to date. And really a lot of that was driven by the uncertainty surrounding the new legislation coming out of the One Big Beautiful Bill and the tax exempt status of munis. So with that uncertainty, investors pull back from the marketplace. Muni treasury ratios, which is really what we look at from a relative value standpoint, went from 81% to about 104% in that dirt cheap level. And right now they're stabilized around 96.5%. But when you take a step back and you look at taxable equivalent yields that you can capture in the municipal marketplace, you're looking at north of an 8% for the average investor. That's a really attractive relative value opportunity set in the market.
Definitely. I want to come back to the bill in a second, but when investors think munis, they often think safe, reliable, tax exempt. What else should they be thinking? Why is there more to munis than meets the eye, so to speak?
Yeah, that's a great question. So investors should really think about how they can generate alpha out of their muni portfolio. Traditionally, investors have come to the muni market for tax exempt yield or tax exempt income. What a lot of investors leave on the table is that opportunity for total return and to generate alpha in the portfolio. And by looking at the municipal market from a relative value active manager's standpoint, we can help investors to really unlock some of that value by focusing on credit research, focusing on curve positioning, moving up and down the curve where the cheapest part of the market is, sector rotation. So these are just some of the levers that we can pull as an active manager in order to unlock some of that alpha for investors.
Yeah, speaking of curve positioning, you run a number of muni ETFs, but you're here to highlight one in particular. That's the NYLI MacKay Muni Intermediate ETF, ticker MMIT. So why the focus on intermediate duration there?
With all the volatility that we've seen in fixed income markets and interest rates, you look at an intermediate bond portfolio, and that's going to mute some of that interest rate volatility for you. MMIT has a little over a 5-year duration. That is going to be much less volatility than, say, a 30-year bond that has a much longer duration. You can also capture some really attractive income, as we talked about. The 12-month distribution yield on MMIT is at 3.65%. You also pick up credit quality. I'm sure there's a lot of investors out there that are still sitting in money market funds or CDs or even a U.S. Treasury bond ladder. You pick up credit quality in your municipal bond portfolio following the downgrade from Moody's earlier this year. We still have 13 states that are AAA rated. So when you look at the after-tax yield on a Treasury bond portfolio out 5 years, the after-tax yield is going to be about a 2.65%.
And from a practical standpoint, how should advisors think about implementing these funds in a balanced portfolio? Should they approach them kind of the same way they would a core bond allocation or treat them more as supplemental?
You can look at it in any number of ways. It's definitely a product that you can use as a core allocation to the asset class. It's going to get you diversification income and like we said, the prospect for total return. But you can also use it from a number of different ways. You can use it tactically. As we talked about, there's been some volatility in the interest rates and in fixed income markets. So taking advantage of those short-term pricing inefficiencies, adding to your allocation of munis, chances are most retail investors or individual investors are underweight munis, just given the run-up that we've seen in the equity market over the last 3 years. So adding in times of volatility has proven beneficial historically for munis.
Yeah, absolutely. It does look like munis are looking more attractive to our advisors when we pull them these days. So that's promising at least. But lastly, I got to go back to that big, beautiful bill, from President Trump. So what are the main impact that you're seeing from munis on it from a tax perspective?
So taxes really didn't change for the most part for investors. They extended the Tax Cut and Jobs Act tax brackets from 2016. So the tax brackets didn't really change. There's some movement around the outside as far as the SALT cap deduction. That really benefits some of the lower income retail investors in our marketplace, while phasing out some of the higher earners in our marketplace. So really putting a nice demand back into munis for those high earners.
All right, that does it for ETF 360. My thanks to John Lawlor for joining us, and thank you all for tuning in. Don't forget to check out more of our content on etftrends.com. We'll see you next time right here on ETF 360.